Just over 8 months since Fed Chair Powell panicked and pivoted as global stocks and bond yields tumbled, the Fed flip-flop is now complete, as the Fed has cut rates by 25 basis points for the first time in about 11 years. Also of note is that the Fed has ended the normalization of the balance sheet 2 months ahead of schedule. In recent statements, the Fed praised the U.S. economy, but blamed the rest of the world for the reason for cutting rates. So, when the Fed cut rates, how does this affect you as a consumer? And how does this affect you as an investor? Well, let's take a look. As a consumer, there are multiple ways that you and your spending may be impacted by a Fed rate cut. Most credit cards have variable interest rates and they're tied to the prime rate, or the rate that banks charge their preferred customers. But the prime rate is based off of the Fed's key benchmark policy tool, the federal funds rate. In other words, when the Fed lowers or raises its benchmark interest rate, the prime rate will typically follow, and this in turn will affect credit card rates. If you're a saver and have money in the bank, you most likely won't feel like a beneficiary of a Fed rate cut. That's because banks will typically lower the annual percentage yields they offer on their consumer savings account. But when and by how much banks choose to lower yields after a rate cut also depends on other conditions, such as competition from other banks. On the other hand, mortgage rates aren't likely going to respond quickly to a Fed adjustment. Interest rates on home loans are more closely tied to the 10-year Treasury yield, which serves as a benchmark to the 30-year fixed mortgage rate. As an example, the Fed hiked rates 4 times in 2018, but mortgage rates continued to edge downward in late December. However, the Fed funds rate and mortgage rates both end up being influenced by similar market forces. However, if you have a mortgage with a variable or a home equity line of credit, also known as a HELOC, you'll experience more influence from the Fed. Interest rates on HELOCs are often pegged to the prime rate, meaning those rates will generally fall with a Fed rate cut. Lastly, if you're thinking about buying a car, you might see some relief on your auto loan rate. Even though the Fed funds rate is a short-term rate, auto loans are often tied to the prime rate. But given the relatively short term of an auto loan, the benefit will likely be small. So now let's look at the stock market. So far, Fed Chair Powell has a losing record on Wall Street regarding the market's reaction to Fed statements. He has had 2 winning days out of the past 11 Fed meetings, with the only positive gains for the market coming in January when there was a pause in the string of rate increases. So the big question following the Fed rate cut is, can a reduction in rates help the stock market? Beginning toward the end of 2015, the Fed has had a run of 9 rate increases. Again, this is the first rate cut in a long time. So what should we expect with a 25 basis point cut? Well, the good news is that as you may expect, the stock markets tend to rally after rate cuts. The reason is that rate cuts translate into lower borrowing costs for individuals and corporations and thus tend to support higher moves for stocks. And as you can see from this chart here, since 1990, the S&P 500 has gained an average of 0.16% on the day of a 25 basis point cut. 1 month later, the S&P 500 has typically been 0.57% higher. If the rate cut was 50 basis points, the market generally rallies by 0.34% on the day of the rate cut and 1.25% higher a month later. Interestingly, a 75 basis point reduction has typically resulted in a more powerful move of 2.76% on the day of the cut, but only by 0.27% in the following 30-day period. Perhaps we should be glad that the Fed only cut rates by 25 basis points because history shows that the greater the magnitude of the rate cut, the weaker the returns over the coming 3 to 6 month time frame is. And as you can see with this chart here, it seems that a quarter of a percentage point cut tends to be the Goldilocks number, as shown in the far right column. On average, the 6th-month return following a 25 basis point cut is up to 5.64%. Cuts of 50 basis points or greater resulted in losses in the coming quarter and half-year periods. And yes, part of the story is that the larger rate cuts are generally associated with much weaker economic conditions, and this recent cut is being sold as the so-called insurance cut. But immediately following the Fed's announcement, Goldman Sachs came out with their 2020 stock market forecast. Well, according to Goldman Sachs, expect another year of double-digit gains for the S&P 500. Goldman raised its S&P 500 year-end 2019 target to 3,100, up from 3,000, and also introduced a year-end 2020 price target of 3,500 on the S&P 500 as lower interest rates from the Federal Reserve are anticipated to continue to drive the rally. But then came Thursday, and so just as investors thought it was safe to buy the dip after Wednesday's plunge, President Trump announced new China tariffs. And I quote, on September 1st, putting a small additional tariff of 10% on the remaining $300 billion of goods and products coming from China into our country. And poof, there went Thursday's rally. So I suggest you stay tuned to this channel to find out what happens. And for today, that's ChewDog Charts. Thank you.